Spending $10,000 a month in retirement isn't just for the ultra wealthy. In fact, many retirees are doing exactly that comfortably and confidently. In this video, I'm going to show you how. We'll talk about the portfolio size you actually need, the withdrawal frameworks that make this spending sustainable, and the hidden risks that can blow up your plan if you don't account for them. I'm a certified financial planner and the owner of a fee-only financial planning firm, and I help retirees build income plans that support the lifestyle they want without relying on hopes that the market will always go up. If your ideal retirement includes travel, time with family, or the freedom to spend without pinching every penny, this video is for you. By the end, you'll have a clear picture of what it takes to make a $10,000 lifestyle not just possible, but sustainable. We're going to walk through the exact withdrawal strategies and assumptions that allow you to confidently spend $10,000 a month or $120,000 a year in retirement without running out of money. Let's dive in. So, how much do you really need to spend $10,000 every single month in retirement? Let's first define what $10,000 really means in retirement, because it can mean different things whether it's pre or post-tax, whether it includes housing costs, and other factors. In my experience as a financial planner, when retirees say I want $10,000 a month, they mean they want $120,000 per year after taxes with a paid-off mortgage, most of the time. And that number tells us something really important. It's not just about covering basic expenses and surviving. For a lot of people, spending $10,000 a month means you're aiming for travel multiple times per year, internationally, and in style. Doesn't have to be business class, but maybe economy premium. Or maybe if you're more family oriented, you can give generously to your kids, to your grandkids, pay for their education, take them out for dinner every single week, or take them on a really big family trip. Most importantly, though, it's the idea of doing what you want to do without looking too closely at the price tag. But that dream lifestyle does come with a big question. Can your portfolio keep up with that level of spending for 30 to 40 years without running out? The last thing people want to do is run out of money and have to go back to work in their 80s. So to answer that, we need to look at withdrawal strategy frameworks. If you spent any time looking at retirement rules of thumb, you've probably heard of the 4% rule. The 4% rule is a retirement spending guideline that suggests you can safely withdraw 4% of your portfolio in the first year of retirement, adjusting for inflation each year without running out of money for a 30-year period. So if you want $120,000, you take $120,000 and divide it by 4%, which equals $3 million. And that's the ballpark estimate for a $10,000 a month lifestyle using the 4% rule. But here's the problem with that. The 4% rule is based on research from the 1990s by financial planner William Bengen. It assumes a fixed 60-40 stock to bond portfolio, a 30-year retirement, and inflation-adjusted withdrawals, but it doesn't account for taxes, healthcare surprises, or major spending shocks. While Bengen did test for a sequence of returns risk using historical data, the rule itself doesn't adapt in real time, and it assumes that retirees keep spending steadily no matter what the market is doing. Even Bengen has said that it's more of a historical observation than a rule for the future. In today's environment, with longer retirements, higher healthcare costs, and more market uncertainty, it's a starting point, a rule of thumb, which is not a bad thing, but it's unrefined. So if the 4% rule is unrefined, what is a better way to figure out how much you can safely spend? That's where dynamic withdrawal strategies come into play. Strategies like the guardrails approach, which I'm going to talk about momentarily, or the retirement spending smile, which allows for flexibility, context, and even room for increases in your retirement budget over time. So what exactly is the guardrails approach? Here's the idea. Instead of spending a flat 4% for 30 years, we create an upper and lower limit on spending based on how your portfolio is performing over time. If the markets do well, your spending guardrails allows you to give yourself a bonus, and if markets take a hit, the lower guardrails trigger a belt tightening or a temporary cut to spending to keep your plan on track. And when you apply the guardrails approach to a $10,000 a month retirement goal, you don't necessarily need $3 million. You might be able to make that lifestyle work with more like $2.4 to $2.6 million, which depends, of course, on your Social Security or pension amounts, your retirement tax bracket, your time horizon, and of course, how much spending flexibility you're comfortable with. Let's look at an example to make this a little bit more real. Meet David and Lisa. They're both 62 and want to retire next year. Their goal is a consistent $10,000 a month in spending after taxes or $120,000 a year. Their financial picture includes $2.6 million in retirement savings, 70% of which is in pre-tax IRAs and 30% in a taxable brokerage account. They do not have a pension, and they're planning to delay Social Security until age 67. David's benefit will be $3,200 per month, while Lisa's benefit will be $2,800 per month, for a combined benefit of $6,000 per month. Now, the first step with retirement planning is to understand the spending gap. From age 63 to age 67, they're going to need to fully fund that $10,000 a month from their portfolio because they won't be yet claiming Social Security. So that's $480,000 over 4 years plus taxes. Even if we assume favorable tax optimization, they're still going to need to withdraw about $130,000 a year gross during those years to net $120,000 after taxes. And this is where sequence of returns risk comes into play. Those early years without Social Security are the most vulnerable. If the market drops in year 1 or 2, it can completely derail their long-term plan unless they adjust their spending or have cash reserves on the side. So how do we solve for that? Let's try running their numbers through a dynamic guardrail system. At $2.6 million in assets and using a conservative 5.25 long-term growth rate and inflation at 2.5%, the plan supports $120,000 net per year in retirement spending with annual cost of living adjustments, plus guardrails that automatically adjust spending up or down 5 to 10% if their portfolio deviates from the targets. The early gap years between the ages of 63 and 66 are handled through withdrawals from their taxable brokerage account first, which keeps their tax brackets low and minimizes IRA distributions early on. Then at 67, their $6,000 a month Social Security kicks in, cutting their portfolio needs in half. So from that point forward, they only need to withdraw about $50,000 to $60,000 per year from their portfolio, which is highly sustainable under the guardrail approach. But we're not done yet. We still need to stress test the plan. What happens if there's a big market crash? Let's say their portfolio drops 20% in year 1. The guardrails framework would suggest cutting spending temporarily by about 5% or about $500 per month. This could mean delaying larger discretionary purchases like a big trip or a remodel. And more importantly, it keeps withdrawals under control until the markets can recover. This minor spending trim or delay in spending early on preserves the integrity of the plan and gives the portfolio time to recover. In comparing that to the 4% rule where you just keep withdrawing the $104,000, which is 4% of $2.6 million, even as your portfolio drops, this can lead to faster depletion of your assets. The bottom line is that the numbers work. David and Lisa can confidently spend $10,000 a month with a $2.6 million portfolio as long as they build flexibility in using a guardrail system. They optimize taxes, meaning they delay IRA withdrawals early, they utilize their standard deduction, and have 0% capital gains rate based on their income. They plan for the early retirement income gap carefully, and they stay emotionally grounded during market volatility. So the most common fear in retirement by far is the fear of running out of money, but there's actually a strange paradox that I see over and over again. The retirees who are most financially prepared are often the least willing to spend the money that they've saved. And it's not because they want the lifestyle. They dream of visiting every national park in an RV, or booking that river cruise in Europe, or maybe spending a few months in Europe at a time. Maybe they want to renovate their kitchen, or host their family for the holidays, or spoil their grandkids by taking them on a big trip. But when the moment comes to actually pull the trigger on spending, they freeze. Why? Could be analysis paralysis, but for 30 to 40 years, they've been in saver mode, scrimping, investing, delaying gratification, and suddenly they're asked to flip the script to start drawing from the very accounts that they've been trained to set aside and never touch. This is why I often compare retirement to climbing a mountain. You spend 30 to 40 years steadily making your way up the mountain and reach the peak, which is retirement, and then spend 30 to 40 years climbing down the mountain, which is a completely different game and often much more dangerous with different focus points. Behavioral economists call this scarcity mindset inertia. When you've trained yourself for decades to protect your nest egg, spending it, even if it was rational, can trigger a lot of fears. Again, the number one fear among retirees is running out of money, but for a lot of folks, the real danger is underspending, which can be just as costly as overspending, just in a different currency. It costs you experiences that you can never get back. It costs you time with people who won't be here forever. And it costs you the confidence to actually live the life that you wanted to. This is not just philosophical, it's backed by data. In a 2023 study by BlackRock, 59% of retirees with portfolios over $1 million said they wished they had spent more in their early retirement years. Nearly all said they feared not knowing how much they could afford to spend. And this is why the guardrails approach changes everything. This is where the technical meets the emotional. The guardrails approach doesn't just optimize your numbers, it gives you permission. Permission to spend more when the market's doing well, permission to make small cuts when needed before it's too late, and most importantly, permission to stop second-guessing every financial decision you make. Think of it like a smart thermostat for your retirement. You don't have to obsessively adjust the dial every 10 minutes. It keeps things comfortable and lets you focus on living. So let's take a step back and answer the big question clearly. What does it take to confidently spend $10,000 a month in retirement? The truth is you do not have to be a genius investor, and you certainly do not have to be scared of enjoying your money. What you do need is a plan that includes a portfolio of around $2.5 to $3 million, depending on your Social Security timing, tax strategy, and lifestyle flexibility, a smart withdrawal strategy like the guardrails method that adjusts with the market instead of locking you into unrealistic assumptions, a clear understanding of your gap years before Social Security kicks in and how to bridge them efficiently, and most importantly, the courage to live the life that you've spent decades working for. I've worked with hundreds of retirees over the years, and here's what I've learned from working with them. The happiest ones weren't necessarily the wealthiest. They were the ones who had clarity and confidence in their numbers and understood exactly what they wanted so they could stop worrying and start living. So whatever your retirement dream is, whether it's traveling or supporting your family or just relaxing in peace without worrying about every dollar, the path to that lifestyle is the same. You need to build a plan, follow the guardrails, and give yourself permission to spend like you mean it. Now, if you want to see how this strategy fits with your numbers and your particular lifestyle and want to talk to a fee-only financial planner, I would love the opportunity to support you. Head over to my website to schedule a free consultation. I work with clients virtually all over the country, and I'd be happy to help you feel more confident about your next steps into retirement. Of course, don't forget to like and subscribe. I appreciate it very much. Thanks so much for watching. See you next time.